In early 2025, the headlines were apocalyptic. The Tariff Armageddon was supposed to be the tax that ended America.
25% decline in the stock market, 5 million jobs lost. A 1-year recession, and an unemployment rate that goes up to 7%.
The models built by the most prestigious institutions in the world predicted a total collapse of the consumer, a 1930s style trade war, and the death of the global economy. But it's 2026, the data is in, and there's still no Armageddon. While core good prices have seen a small temporary bump, the systemic collapse never happened. Why? Because the models were using the wrong map. They treated the US as a passive participant in trade rather than what it really is. The world's only monopsony superpower. Today, we're going to look at the objective math behind the buyer's premium, why Milton Friedman's tariff-free capitalism is a dangerous myth for the world we live in today, and the second and third order effects that are currently rebuilding America's industrial base. To understand why tariffs didn't cause inflation to spiral out of control like everyone was saying it would, we have to understand the monopsony power. In economics, a monopoly is a single dominant seller. A monopsony is a single dominant buyer. The US consumer market is the largest, most liquid pool of capital in human history. For an exporter in Shenzhen or Vietnam, losing access to the US market isn't just a bad quarter. It's an existential threat. When the 2025 tariffs hit, the expert models assumed that there would be a one-to-one pass-through to the consumer. But they ignored margin absorption. Because the US is the most important buyer, exporters were forced to make a choice. Raise prices and lose the American customer to a domestic competitor, or eat the costs. Data from late 2025 shows that in many sectors, up to 40% of the tariff costs were absorbed by the exporters or the government through increased subsidies just to maintain their current shelf space. We used our leverage as the world's biggest buyer to force other countries to pay our taxes for us. This is the buyer's premium. Critics often cite Milton Friedman's love letter to Hong Kong. He argued that if a foreign country wants to sell you cheap goods, you should just say thank you and let your own inefficient businesses die. He literally says, adapt or die. But there is a massive difference in economic might and scale. First, the city-state versus the empire. Hong Kong is a 400 square mile rock with no natural resources. It has to trade to survive. The US is a 3.8 million square mile behemoth with the world's best farmlands, energy reserves, and internal markets. Second, the welfare state trap. Friedman himself later admitted that you can't have a free market and a welfare state at the same time. If you allow a factory in Ohio to be closed due to the subsidized dumping of cheaper products from another country, the efficiency gain you get from those cheaper products is wiped out due to the social costs of the unemployment, the increased crime, and the hollowed out tax base. In a vacuum, Friedman is right, but in a world of hostile socialized markets, he's a liability. You can out-innovate a competitor. You can't out-innovate a foreign government that dilutes its currency 15% just so their steel is cheaper than yours. Most people only look at the first order effect like a price going up. A world-class investor looks at the second and third order effects. The second order? Industrial clustering. When a tariff makes a domestic factory viable again, it's not just about that single factory. It's about the economies of scale. When you build chips in Arizona or steel in Pennsylvania, you create a gravitational pull for other companies and new talent. Supply chains that were 8,000 miles away are now only 8 miles away. This reduces the uncertainty tax, which is the hidden cost of geopolitical instability throughout the world. The third order, the innovation multiplier. When manufacturing leaves a country, research and development follows it. You can't innovate on a product that you don't even know how to build. By reshoring the physical labor, we're reshoring the intellectual property. That isn't a coincidence. That's a third-order benefit of protecting your battleground. We aren't protecting weak companies. We're protecting free market players from hostile state players. When a state-backed firm dumps steel, EVs, and other products at 30% below production costs, they're not competing, they're cheating. You cannot out-innovate someone who is cheating. The only way to keep the market free is to put a tax on their buy-in. Finally, we have to talk about the adversary tax. For 30 years, we have chased the China price. It has been the ultimate first-order win. We got cheap TVs, but the unspoken cost of this was a complete dependency on our number one geopolitical rival for things like defense, medicine, and technology. In 2026, we've realized that national security is an asset class. If a 10% increase from a tariff is the insurance premium that we pay to ensure that our pharmaceutical supply chain isn't controlled by a hostile country, then it might be the best investment we ever make. Reliance is a liability. Resilience is an asset. When the experts screamed Armageddon, they were looking at the price of a toaster in 2024. They weren't looking at the price of the war that we avoided in 2030 because we weren't too dependent to stand our own ground. The Tariff Armageddon didn't happen because American businesses are more adaptable and American leverage is more powerful than the models allowed for. We're moving away from the efficiency at all costs era to the resilience and leverage era. It's not about isolationism, it's about reciprocity. If you want to sell to the world's biggest buyer, you're going to have to play by our rules. You don't manipulate your currency and you don't dump your products. The critics were wrong because all that they could see was a tax. The smart investors saw a rebalancing of the scales. I'm the unintelligent investor, and if you want to understand the real forces moving markets in 2026, smash that like button and subscribe so you never miss a video. Let's keep looking at the data objectively. Peace!